Good evening to all my fellow investors. Today we're going to take a closer look at Parker Hannifin, stock ticker PH, a company that specializes in motion and control technologies. And for an aging, slow-growing industrial company, Parker Hannifin has done well to improve their profitability. Of course, macroeconomic factors will always be a temporary issue that investors must overcome. While PH is strong enough to survive past any bear market, I personally think opportunities to invest in PH will arise at share prices below present levels. And if we take a look here, Parker Hannifin is trading at $308. Year to date, they are down just shy of 2%, and over the last year, they are down 7.6%. They did have a massive rally since since end of September until now, gone up around 30%. With that said, let's take a closer look at Parker Hannifin, where we'll first look at some of the fundamentals of the company and then use our 5 valuation model. So Parker Hannifin is trading around 16.3 PE non-GAAP forward ratio compared to a 5-year average of 17.18, so a bit below the 5-year average right now. Coming down to the price to the book forward ratio, 3.47 compared to 3.88, 10% below the 5-year average, so not too big of a difference. If we look at the dividend stats, they offer a dividend yield of 1.72%, a very healthy payout ratio of around 25%, and a really nice 5-year dividend growth rate of 13.72%. And I've grown it for 6 consecutive years. If we jump into the financials, you can see the revenue has growing steadily over the last 5 years from 14.3 billion to 16.3 billion in the last 12 months. And as I said in the start, this is a slow growing industrial company. But if we come down here to the net income, you can see that it actually managed to put on a bit more profitability, around 1 billion in 18, up to around 1.3, 1.25 in 22 and the last 12 months. Jumping into the cash flow statement, you can see here cash from operations, 1.6, 1.7, 2.0, 2.5, 2.4, and 2.4. So they are also growing their cash from operations, which is nice to see, because if we come down here to the capital expenditures, you can see 240, 195, 230, 210, 230, 265. So they are kind of steady in the capital expenditures, meaning they actually generate a lot of free cash flow. And something that I really want to note here is how they deal with those cash they provide. So you can see the common dividends paid was 600 million, well covered by the free cash flow. They are also repurchasing stocks. They are also paying back debt. So I really like how the management at Parker Hannifin is utilizing all their cash. And jumping into the balance sheet, you can see here total cash and short-term investments only 500 million, so they're not hoarding a lot of cash. And if you come down to the bottom, then we can find the total debt and the net debt, and you can see they have around $14 billion in debt, 13.4 in net debt, and they actually took on quite a bit of debt in the last couple of years. So from 6.7 up to 13, so they almost doubled it over the last 1.5 to 2 years. So I would definitely look into why that is. And one final thing to note here is the total shares outstanding on filing date has decreased a slight bit since June 21, but they have also issued a bit in 20 and then repurchased before. So depending on how the stock price is looking, I think they are actually either issuing or buying back shares. So this is looking pretty okay, I would say. That was how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And it's important not to skip ahead in this part, as I'll share the assumptions I'm making for my valuation. So jumping in here, we do have the stock screening where we'll just punch in PH and everything here will fill out. And as mentioned earlier, you can see the dividend yield is 1.72, so everything is checking out pretty okay. And if we jump into the first one, the Graham's revised valuation model, you can see here that we do have punched in a growth rate of 9.36, and that is in line with what the Yahoo analysts are thinking. I think it's looking at the revenue, I think this is pretty decent to say because they have been growing quite steadily over the years. So we get an intrinsic value of 150 based on that. And if you remember, the current price was 308, so that is a bit off. We also punch in the current yield of the AAA corporate bonds, which is 4.59 at the time of recording. Jumping into the next one, we do have the discounted cash flow model, and we apply the same, the growth rate of 9%, because as you saw with the capital expenditures from a cash flow statement, they are actually generating a lot of cash and are going up in that regard as well. So I don't have any hesitations in doing this. And coming down here to the chart, you can also see they are, the years that are really good, they are really, really good. And of course, some of them is not that good coming off, for example, after COVID here, but still, it's looking pretty decent, I would say. And when we punch in the cash and short-term equivalents, total debt, shares outstanding, then we get a fair value of 306, very close to the current price. Jumping into the dividend discount model, we put it the different payouts for the different years. We then calculate that back with the growth rate. I have still used the applied growth rate of 9% because they have actually grown their dividend quite heavily. You can see 15, 17, 29%. So I think that's pretty fair to say they'll probably continue in the roughly the same tempo, maybe not as high, but still in a quite good tempo as well. So I put in 9. That gives us an intrinsic value of 335. Coming into the next one, you can see we don't have too many to compare to due to the EPS is probably negative for those companies right now. So we do only have really Otis and FTV to compare it with. And if we do that, then we get a stock price of just shy of $300. The last one we have is the free cash flow valuation. And if we take a look at the price to free cash flow ratio, the price to operating cash flow ratio average, and the free cash flow per share, we get an intrinsic value of 237. Before we get into the summary, if you have come so far, thank you so much for watching this video, and please like the video and subscribe to support the channel. Jumping into the summary for Parker Hannifin, we do have our 5 valuation model, which everything gets pulled into here. The average intrinsic of those are $265. With the current price being 308, the average discount is minus 16%. So even if we want to apply a margin of safety here for, let's say, 10%, then we do have some way to go before Parker Hannifin is in an acceptable buy range. And if we just leave here, let's say 10%, and even let's say if we do want to pay a 10% premium, we can put in minus 10%. That gives us a 10% premium more than we actually supposed to pay, and that is still not there. So as mentioned in the start, I do like this stock, but I really want it to come down a bit before buying. So let me know down in the comments if this is a company you're interested in, and if not, I'd love to hear as well. Thanks again for watching.